Hey everyone, welcome to another video with another stock idea. Today I want to talk about Discovery Inc. You can see this on my screen is a chart over the last few years, and you can see that it's basically gone absolutely nowhere in this past decade. But I think that it could be a good time to buy this stock. You can see that it's down near its lows over the last decade, and it's revisited the $20 area quite a few times and has bounced from there. So I want to first off go over some basic numbers about Discovery, and then I also want to look at a DCF model that I created using finbox.io. More about that later. But first, just want to give an overall lay of the land. You can see that Discovery has a market cap here of about almost 10 billion, and it has net debt, so it's got debt on its books of about 14 billion, right? So combined, net debt and market cap combined, market cap is the equity value of this company. Those two combined is what we call the enterprise value. So this $24 billion number, that's the enterprise value. So if I was Warren Buffett and I wanted to buy this company, it would cost me 24 billion, assuming that I don't have to pay a premium for the company. So that's what the total enterprise value is today, is 24 billion. Okay, so what does Discovery do? Many of you may know Discovery because of Discovery Channel. So you may have guessed that Discovery Inc. is a media company, right? They own a handful of cable channels worldwide, quite a few actually, and they make their money primarily, mostly more than 50% on advertisements, selling ads on their different channels and their different outlets, and another big chunk on what's called affiliate fees. So cable companies like Comcast have to pay media companies like Discovery a fixed fee for each subscriber that has Discovery Channel, for instance, in their cable bundle. And so that's a kind of a subscription or recurring revenue for Discovery. It's just the mere fact that these subscribers have the channel in their bundle, which you might be thinking, well, that is a declining business because so many people are cutting the cord, right? That's true, but there are other platforms out there, digital streaming platforms, that are also adding Discovery's channels and would have to pay a fee to Discovery. So it's not completely dying. So this, by the way, is the 10K, the latest Form 10K. Every public company, if you're not aware, has to file a Form 10K once a year. It's their annual report, and there's a wealth of information that you can find in the 10K. They also file what's called a 10Q every quarter. That's not the so there'll be 3 10Qs and 1 10K every year for each publicly traded company in the United States. So the neat thing about Form 10K is if you go, the first section in each 10K will be a section called business. So if you're ever wondering what a company does, look up their Form 10K, go to this first section called business. You'll get a very detailed description of what the business does. This goes on for several pages. So, okay, so you can read through this. I just wanted to show you mainly over here. These are the different brands, the different network brands that Discovery owns, basically the different channels, right? So you got Discovery Channel, you've got HGTV, got Food Network, TLC, Animal Planet, Investigation Discovery, Motor Trend, Travel Channel, Oprah Winfrey Network. Those are the US networks, right? Internationally, they don't show the logos here, but they own things like Eurosport. You can see that here. Discovery Kids, DMAX, Discovery Home and Health, TVN. But interestingly, if you look up here, I didn't realize that their reach was so vast. They say, we provide original and purchased content and live events to approximately 3.8 billion cumulative subscribers and viewers worldwide. So that's big reach, right? 3.8 billion, that's over half the people, or about half the people on the planet. So the reason why I'm super excited about Discovery Channel is, number one, where it's at value-wise and the quality of its assets. Very popular TV channels here in the United States. It's got some popular ones worldwide. And I think one of the most exciting things that I think I heard this on a podcast or something, is that Discovery Channel, and I've also confirmed it by looking elsewhere, Discovery Channel is the number one media cable company, is the number one media company for women like ages 25 through 50, roughly, right? So for female viewers in that demographic, Discovery Channel is one of the, not Discovery Channel, but Discovery's group of channels, especially TLC, HGTV, Food Network, things like that, are the number one destinations to reach female viewers. So advertisers will pay up to reach those viewers. That I thought was very interesting. And another interesting thing is that the content cost for Discovery, if you think about the different shows, Property Brothers, the Chip and Joanna Gaines show, whatever, Fixer Upper, those are not super costly to produce compared to other content that like Netflix or other media companies are producing, right? And so they can pump those out pretty quickly. And they have said that they can get back up to speed really quickly. Right now a lot of production shut down because of the pandemic, but they believe that they can get up and running pretty quickly because of the type of content they produce, and they're still able to produce a lot of things at home while people are at home, like cooking shows and whatnot of famous people cooking in their homes, things like that. So that's just a little background. That's kind of the story behind this stock. So I always like to look at what's the story, and now I want to look at what are the numbers. Okay, so this is a website called finbox.io, so finbox.io. This is a really cool website. I do pay for this service and to access it. They've got a number of different plans, pretty affordable, but it's a monthly fee, or you can pay annually, quarterly. But here's a 10-year DCF model. They call this the growth exhibit. I just say this is a standard 10-year DCF with a perpetuity at the end. So you're adding a terminal value at the end. So this is the model that I've used, or that I customized based off the Finbox default model. By default, Finbox will put its own estimates, as you can see down here, for revenue and revenue growth over this 10-year period. These numbers, I'm told, come from analysts, the analyst community, at least for the first few years here, and then some kind of rules of thumb to determine the growth in the outer years. Now you can see a quick summary here. We've got a discount rate of 9%, which I think is pretty reasonable in the current environment. Perpetuity growth rate, this is kind of the growth rate we're assuming for the company's revenues and earnings going out into perpetuity, meaning forever, assuming that this is a going concern. Fair value that we reached, we think it's kind of in this range here. And upside potential, you can see quite a bit of upside is what I'm thinking based off this model. Now, if you go to other places like Morningstar. If you have a Robinhood account, by the way, and you pay for the gold, you can see you can see Morningstar's estimate of fair value for the stocks that they follow. And last I checked, Morningstar has a fair value estimate for Discovery at $30. So look at the growth here. We're assuming a hit to growth this year because of the pandemic and the slowdown in ad spend. And then we are going to kind of rebound the next year and then slowly grow from there. This is the assumed EBITDA margin. If you want to kind of see historically, you can go down here to historical financials. You can see the EBITDA margin has been historically around high 30s, low 40 range. So we're assuming 37% to going up to 39% towards the end of this 10-year period. That's how we get EBITDA, which is earnings before interest, taxes, depreciation, amortization. It's roughly a proxy for operating cash flow. So operating cash flow is before capital expenditures. Free cash flow is after you make those capital expenditures. So here we get the calculation of free cash flow. You can see they start with the EBITDA, and then they subtract out depreciation to get to EBIT. Do some taxes, assume taxes at an assumed tax rate. CapEx here, so you subtract out CapEx from this net operating profit after tax. Add back any investment. You subtract out typically any increase in net working capital. Typically when revenues decline, net working capital investment goes down, which means you have more cash freed up. So, and then you add back the depreciation because that's not a cash expense. We could do another video in more detail this, but later. But just notice free cash flow here. It's about $3 billion a year starting, and then growing slowly over time to reach about 3.8, 3.5 terminal value free cash flow. Right, so we're assuming 3 to 3.5 billion every year of free cash flow that this company is going to generate for the firm. This is for all stakeholders, debt holders and equity holders of the company. Right. So then we look at this calculation of enterprise value, and you can see I've got my cash flows here, but we've got to discount them back to present. And like I said earlier, we're using a 9% discount rate in this middle scenario. And so that means when you discount the present value, the further out in time you go, the less valuable those cash flows are. So we're assuming the present value, for example, in this 2029 cash flow. So we're assuming the cash flows in 2029 are worth 1.7 billion today, even though in real term or in nominal terms they're worth 3.8 billion in that year. So we add these together and we get 23 billion is how much cash flow they're going to bring in over the next 10 years, right? But then if we assume everything after year 10 has got value, right? If this company is going to keep going. So there's a calculation you do in these models. It's not a complicated calculation. We can go over that sometime. But you arrive at the value of all the cash flows after 10 years to be 22 billion. So you add this 10 years worth of cash flows of 23 billion to the 22 billion after the 10-year period, and you get a total enterprise value for the company of $45 billion, right? Now that's for the entire company, for debt holders and equity holders. If you were just to buy this company like you were Warren Buffett, we're saying it's worth about $45 billion because you're going to generate about 3.5 billion in cash flows every year, right? Which is, it's like 12, 13 times. No, it's more than that. About 14, 15 times your cash flow, your free cash flows, right, for the whole enterprise. So then we look at the equity waterfall. So this is our concluded enterprise value, but we got to add how much cash they have in the bank. Maybe they have some investments in other companies. We got to add those, the value of those, but we got to subtract out debt. This is to get to equity, the value of the equity, right? So we subtract out how much debt they owe here and here, and that's where we get to 30 billion as the assumed value for the equity, which is what the shareholders own, right? And then we divide that by the number of shares outstanding, which is 670 million, to arrive at $45 a share assumed value per share. So hopefully you followed that. If you have questions, feel free to leave them in the comments below. But that's what I'm assuming is, I think they're worth about $45. I always like to give myself a good margin of safety. I think at today's price, $21.28, that you do have a significant margin of safety. So even if this went up to 30 bucks a share and you decide to get out then, that's totally fine. You'll still make money. And so I think there's a very wide margin of error in these numbers where it could be worse than this and you would still make money. And that's the type of investment that I like, that I'm looking for. In my next video, I will talk about how you can play this with options, right? So a lot of people have Robinhood accounts. A lot of people are getting to options trading. I like to call it options investing. That's what I do, where I'm investing, but the vehicle I'm using to invest is options, because you can essentially get more bang for your buck, right? And if you can use less capital to make your investment, that means you have more cash that you're not using that you can save for a rainy day. Anyway, if you enjoyed this video, please subscribe and I'll continue to make more. If you have a stock that you want me to look at, please comment in the comment section. And until then, enjoy being at home if you're at home.